Now we're going to learn how to prepare a payroll register. On page 265 of your handout, you can see the payroll register, and I'm also going to show it on the next two slides. What the payroll register includes is each employee's gross earnings, their withholding taxes, their net pay, their taxable earnings, and their cumulative earnings, and the accounts that their gross pay will be charged to for budgeting purposes. So this will all make more sense once we look at one. So this is the first screenshot of what a payroll register looks like. So notice at the top it tells us what the company is. It's called travelwithus.com. And then underneath that is the three-line heading is the title of whatever it is we're looking at. In this case, it's the payroll register. And in this example, it's the one for their hourly employees, which is saying that they probably have a separate one that's just for their salaried employees. And then the third line is critical. Notice this payroll register is showing just a part of the year. In other words, it's showing one pay period's worth of information. So this is really important to understand. The payroll register is filled out for each pay period. And because it's for each pay period, it's going to have a list of all the employees who were paid on that pay period. If we look at the far left column, we notice we have 3 employees: Stephanie Higuera, Annie Swee, I'm not sure how to pronounce that, and Harold Taylor. And it also includes their social security number. The next column, we've got allowances and marital status. So what tax do we need to know their allowances and their marital status? That's for FIT, federal income tax. FIT's the only one that we need the allowance and marital status information for. And then we have our previous earnings year to date. In other words, this is their gross pay prior to this paycheck. Why do we need that information? Well, we need that information for any tax that has a wage base. Do you remember which taxes have a wage base? Social Security, FUTA, and SUTA. So this allows us to determine if each employee has gone over that wage base, in which case we need to stop recording that tax. And then under the current earnings, we have our regular hours and the rate and the amount. Let's look at Stephanie Higuera. She worked 78 hours in this pay period. She gets $11.40 per hour, and you multiply that together, and her gross pay for her regular hours are $889.20. Next, we have our overtime hours. She worked 4 hours in overtime, and her overtime rate is 17.10. How did that get calculated? Well, we take her regular rate, 11.4, in other words, $11.40 an hour, multiply that times 1.5, and that gives us 17.1. So to get her overtime pay, we take the 4 hours times 17.10 gives us 68.4. And then the gross wages of $957.6, that's calculated by taking her regular amount and adding her overtime amount. And the current earnings year to date takes the gross pay and adds it to the previous earnings year to date column. On the next slide, notice the first 2 columns are taxable earnings. This is not the tax. This is just taxable. And they combine FUTA and SUTA together in one column because the book is assuming that they both have the same wage base, so we can combine their information into the same column. It looks like there's only one person, Annie, who has any taxable FUTA and SUTA earnings. Why is that? Because Stephanie and Harold must be over that $7,000 wage base for FUTA and SUTA. And then we also have a taxable earnings column for Asti, because remember, Asti has a $102,000 wage base. And then we have a column for their FIT, federal income tax, We have a column for SIT, state income tax. And then notice these are all deductions that we're talking about now. And then we get FICA, OSTI, and Medicare. So this first OSTI column is the actual tax for OSTI that we're going to remove from Stephanie, Annie's, and Harold's paycheck. We also have the Medicare deduction. And the way we get Medicare is we multiply the gross times 13.89. Excuse me. We multiply the gross times 1.45%. Going back to OSTI, the way we calculated that is we took Stephanie's gross and multiply it by 6.2%. And then we've got a medical insurance column. Looks like everyone pays $33 per pay period. And then we have net pay. Net pay means you're going to take the gross from the previous slide and you're just going to subtract the deductions. We have the check numbers. Notice they go in sequence. And then we have the account that each person's gross pay is going to be charged to. So what this means is this company has two departments, the business scheduling and cruise scheduling. So apparently these people are travel agents, and Annie specializes in business scheduling, and then the other two people specialize in cruise ship scheduling. So whoever's in charge of the business scheduling department has a budget that they need to maintain. And part of what goes into that budget, what goes against their budget, is the pay of the employees that work in that department. So in this example, Stephanie must work in the business scheduling department because her salary, her gross salary, is being allocated to that department. And then we've got two people, Annie and Harold, who work in the cruise scheduling department. And so whoever's in charge of that department has their two salaries go against his or her budget. Now, some companies will do two payroll registers. As we saw on the previous slide, that was for an hourly, or it was for hourly employees, and they also might do one for salaried people. And the payroll register also includes employees' names and the social security numbers, as you saw on the previous slides.